If you're curious about the truth of annuities, I've got some great information for you. Annuities can be confusing. There's tons of different annuities. One person might say annuities are bad. One person might only talk about annuities and push annuities. And I can tell you, some annuities are good and some are bad. That's the bottom line. So what we're going to do and what we're going to focus on today are just a couple different types of annuities and the pros and cons and the differences. So I'd like to turn your attention to the screen and we're going to take a look at fixed annuities first. So a fixed annuity, also known as a multi-year guaranteed annuity, is a type of a fixed annuity, is similar to a CD, and I'll tell you about the pros and cons of the different ones. But a fixed annuity, such as a multi-year guaranteed annuity, operates in a sense where you have a fixed rate for a fixed term. Okay, and that rate does not change. And typically these fixed annuities won't have fees, or maybe they'll have very little fees depending on the carrier that's issuing the policy. But a fixed annuity, I'll give you an example. Annuity rates as of this video, as of this time that we're filming, are very attractive right now. So for example, there's 3-year multi-year guaranteed annuities that are paying about anywhere from 4 to 5.5%. And that's guaranteed each year, and that's typically with no fees to the firm that's selling the annuity, and then that's typically no fees for the client who has it from the carrier. So fixed annuities are very similar to CDs, but there are some key differences. So the similarities would be that you have a fixed rate for a fixed term. Some differences would be the fixed annuity would be issued by an insurance company, whereas of course the CD is issued by a financial institution such as a bank. Now, the thing about it would be that a CD, when you make money, when you earn interest on a CD, that is reported as income. So you would then get a tax document from your bank, for example, and you'd have to pay tax on whatever money that it made, any interest that it accrued. Whereas a fixed annuity, that money is tax deferred until you take that money out of the policy. So that's a nice benefit, a nice tax savings where interest will compound and your money will grow and you will not have to pay taxes on it until you take money out of the policy, okay? Now, the next annuity that we'll touch on would be a variable annuity, okay? So variable annuities are extremely complex. So you think of fixed annuities, you think of variable annuities, and they are completely two ends of the spectrum. Fixed is very simple in terms, really typically not hard to understand the policy documents, where a variable annuity, we've seen variable annuity prospectus documents and policy pages exceeding 600 to 700 pages and very, very complicated, a lot of provisions, a lot of different scenarios and such. So a variable annuity is tied to the performance of selected funds or tied to the market essentially. So you would select sub-accounts is really what it's called in a variable annuity, and they would go up and down with the market. Variable annuities typically have high fees. Okay, so I'll give you an example. We were sitting down with a client and they said, I'll have you take a look at my annuity statement. And we took a look at it and just said, hey, how much are you paying in fees? And they said, well, my broker told me there's no fees on it. And at that point, we knew that wasn't true. So what we did is we simply asked the client, hey, can we just give the insurance company a quick call just to confirm that? So we gave them a call. We were asking questions to the representative of the insurance company. And without the client even knowing, they were paying 4.5% of annual fees on their $500,000 annuity. So they were paying tens of thousands of dollars in fees that they had no clue about. So if you're someone who's watching this video that has a variable annuity, you definitely want to get it checked out. We can analyze it as well for you, but a variable annuity is typically the annuities that get the bad reputation. We're not too fond of the variable annuities because of the risk. It's up and down with the market. On top of that, anywhere from 2 to even 5% in internal fees. So definitely want to get that one checked out for you. Equity indexed annuities. So this is another terminology for this is a fixed index annuity. So again, we have fixed, we have variable, and then we have equity indexed or fixed index annuities. These ones, this is sort of a happy medium in between these two, where you can really participate in some of the gains of the stock market, right? But you're protected because it is a fixed index annuity, hence the word fixed, where if the market goes down, you would have a 0% return for that year. So, if the stock market's down 10, 20%, you would have a 0, okay? And then if the market's up 10 or 20%, you would participate in some of the gains of the market. So you're going to have a floor of 0. That's the least amount that you can make. And then you can make up to a percentage or a cap or a participation rate. So fixed index annuities, typically you can tie them to the S&P 500 or another index, or and really you have a couple different ways that it gets credited. You have a 1-year index, you have a 2-year index, you have a 3-year index. But to make things simple, you can literally tie a fixed index annuity to the S&P 500, and you can have a participation rate, meaning that maybe the participation rate is 50% of the S&P. So you would participate in 50% of what the S&P 500 makes. So if the S&P makes 20, you make 10. If the S&P makes 10, you make 5. If the S&P loses 20, you stay at 0. So it's a great vehicle for safe growth, because you're not exposed to the downsides like you are with a variable annuity. Another interest crediting way that you can select with a fixed index annuity, and again, this is all dependent on what type of insurance company is issuing the product, but another type of crediting option would be a cap rate. So I'll make it simple again. Let's just select the S&P 500, where again, you might have a 8% cap on the S&P. So if the S&P makes 10, you'd make 8. If the S&P makes 8.5, you'd make 8. If the S&P makes 5, you'd make 5. So you'd make everything up until that cap of 8%. So fixed index annuities are, again, a nice happy medium. Typically, speaking of fees, fixed index annuities, some have fees, but there's a lot of them that don't. And if there are fees on this one, it's typically much, much lower than what you would find with a variable annuity. So I do want to clarify, annuities are not for everyone, nor do we recommend annuities for everyone. It has to be the right situation. And really, the right situation would be someone who maybe doesn't like a lot of market volatility, or can't handle the market volatility, or has a lower risk tolerance, or maybe just wants a principal protected, safe return on a portion of their assets. So annuities are definitely something that has to be right for you. And we do not use annuities with every client. I just want to make that clear. If you're hearing about a firm that only uses annuities, or does not use annuities at all, I could tell you that you want to have more of an agnostic approach where you're open to it, but it has to be the right situation. So again, there's many different types of annuities. I just went over the 3 most popular types, and I'd like to dive a little bit deeper in our remaining time with the power of indexing. So I'd like to focus in on one specific type of annuity that we just touched on, which is the fixed index annuity. So the fixed index annuity and the fixed annuity are the ones that we'll use from time to time if the situation is right for it. But one of them that I'll highlight again is the fixed index annuity. And I'd like to turn your attention to the screen. I know it looks like a lot is here. I'm going to make it real simple and break it down for you. So essentially, this is showing a comparison of $100,000 invested from 2000, and it shows that there's two lines here. One of them is the S&P 500 in the red, and then the other one would be a fixed product with an 11% cap. I know we just talked about caps and participation rates, but this one example is an 11% cap, okay, and shows you how a index product looks over a 10 to 20 year, 25 year time frame. So if we take a look at this $100,000, you can see, let's focus in on the red line. Again, the red line is the S&P 500. S&P, for those of you that don't know, that's your 500 top companies in the country. So that's all stock, right? So stocks can go up, they can go down. We've seen it in history where, you know, it can make big returns, it could lose big returns. So stocks are definitely going to be volatile. So if we take a look over time, this red line, it goes up, it goes down, it goes up, it goes down, it goes up, it goes down, right? So for clients that have a lower risk tolerance, or maybe you know, there's an annuity that we're using that might have a fixed index annuity with an income rider, for example. You know, that's going to be a whole nother video, by the way, is going to be one with fixed index annuities with income riders we're creating pensions for. So stay tuned for that video in the future. But back to this, the green is a fixed index growth annuity with a cap of 11%. And you can see over time, it's rising slowly but surely, it's rising up. But the nice thing about it is every year when there's a down, like this year right here, you know, we go back to the financial crisis, 08, and there was a negative 37% on the S&P, you made zero for that year. So anyone who had a fixed product was definitely sleeping well at night, knowing that their money was not down 37%. So with that being said, you can see how this it essentially smooths the ride out, where you're not taking so many hits over the years. So you can see 08, you know, the market obviously rebounded with some time, but with this product, you know, it's sort of a line just going up over time. And with that being said, we're looking at about a 6.42% average annual return. Obviously, the stock market gives you a little bit more over time, but again, the volatility of the market is completely taken out of the equation with a product like a fixed index annuity. And it may be right for part of your money. You know, think of your money as a pie, where maybe a slice of it might go into something like this, where you can say, hey, you know, during these times when the market is down, and let's say you're needing income, right? You can take typically, you know, annuities, it's typically pretty standard 10% out each year out of the policy you can take out for income needs. So let's say in 2008 here, you know, you had a slice of your pie in something like a fixed index annuity, and then the rest was maybe in equities or a mix of bonds and whatnot. But in 2008, you don't want to take money out of your portfolio that's down 37%. Because that's a recipe for disaster, taking money out when an account is already down. You know, with that being said, 37% is a huge hit. So what we would do in that scenario is we would have, again, a slice of the pie in some sort of a fixed product like this, where we know that it does not go down with market fluctuations. So we could give you income to take that trip that you want. You know, take your family, take your spouse. Maybe there's a home improvement that you wanted, or maybe you just needed income and you needed it now. Well, instead of taking it out when the market's down 37, we could take it out of a slice or a portion of your account that's inside of a vehicle like this that is not subject to market fluctuation. So again, this is just the benefits of downside protection. You do not want, especially as you know, if you're someone who's nearing retirement or in retirement, especially, you do not want all of your money at risk. It may be right for you, it may be not. If you're wondering if an annuity is right for you, definitely let us know, give us a call, get in contact with us, and we can determine that for you.